Hi, welcome to this podcast where I'm going to look at gearing, which is an investor ratio, but it's also a very important ratio for all businesses to consider. Okay, there's two common formulas. The one that's used mainly in A-level examinations, which is the primary reason why I'm doing this video, is fixed cost capital divided by the total capital employed. Now, if you're doing this ratio, you're probably already familiar with total capital employed because that's the figure that we use when we're calculating return on capital employed. And that includes all fixed cost capital and all equity. What we mean by fixed cost capital are preference shares because they have a fixed rate of interest, and also all non-current liabilities. Again, they are fixed cost capital because they have an interest rate associated with them. And for equity, because this ratio is more focused on limited companies, we're going to be looking at all reserves, and that includes retained earnings, things like revaluation reserves, etc., that you will cover in your course. And if we're using this formula, that's the most common one in A-level, then neutral gearing is 50%, because that means that half of the long-term investment in the business is fixed cost or carries an interest that has to be paid, and half of the gearing is in terms of ordinary shareholder capital. There is another commonly seen ratio that is also classed as being gearing, but this is just fixed cost capital divided by total equity capital. I'll just change that there because it's a little bit misleading. So total equity capital only. Okay, and this ratio gives a neutral gearing of 100%. Okay, but that's more for interest, and just because it's important when you use this information in real life and you look at companies, you need to understand which one of the two ratios they've used so you can identify whether it's a company that's highly geared, and even more important, whether gearing has reached a very dangerous level or whether it's lowly geared. Why is it important? I'm going to give you a quick scenario where somebody is a real estate developer and is going to develop some real estate, and it's going to have a cost in total of $1 million, but the profit he's going to make on this is $1 million. So he's going to sell the properties for $2 million. Now, what that means, if there's no loans and all the money, all the $1 million comes from the owner of the business, the investor, then he's going to make, or she's going to make, $1 of profit for every $1 that they invest. So it's good, it's fantastic. They're going to turn $1 million into $2 million with $1 million of profit. You'd be quite happy with that if it was only going to take a year to do. But if we look at the situation where the owner is only going to invest $1 and the other $999,999 is going to come in the form of loans, but provided those loans don't carry any rate of interest, all the developer needs is $1 investment to generate $1 million of profit. And that's a pretty good return on your money, because money is one of the hardest things to get hold of if you're looking at a business idea. So fantastic, you turn $1 into $1 million. Now, I know that's not realistic, and obviously interest is going to be charged on a loan, but even if you're paying 10% interest on the loan, then this property developer is still going to generate over the course of the year $900,000 worth of profit. And so for every $1 of his own money or her own money, they're going to generate $900,000 of profit. And that shows you why it's called gearing, because as you increase the amount of fixed cost capital, provided you're making a higher rate of profit than the actual cost of the fixed cost capital, then you can massively increase the amount of profit that you make for every dollar that you invest. But that comes with a significant risk, because if the investment goes badly wrong, and for example, they find contamination on the land that they've been developing, then it could be that the investor or the owner of the business ends up being unable to sell any of the property and has spent $1 million of their own money, which they now owe in its entirety back to the people who've given the loans. So there's a large element of risk if you become more highly geared. And that risk is that you're not going to be able to pay back the debts that you have accrued, and that's even more significant if there's a high rate of interest. All right, how do we calculate it? Right, a couple of key points. One is we're going to use the equity figures and the loan figures from the end of the financial year when we calculate it. We don't use those figures from the start of the year. I've done an example here of a company, and that company's got ordinary share capital of, and these figures are in millions, so 11,323,000. It's got irredeemable preference shares, which is why they're in the equity section and not as a non-current liability. If they'd been unredeemable preference shares, they would have stayed in the non-current liabilities. Got some share premium, valuation reserve, and this company's got negative retained earnings, which means at some point it's paid out all of its profits and dividend and perhaps made a loss in the next year. And it's got two non-current liabilities, a debenture and a bank loan. And the calculation is very, very simple. On the top, we're going to put all of the non-current liabilities because they have got fixed rate of interest. So that's 3,300,000. And then we need to add on preference shares. Preference shares need to go in because they have a guaranteed fixed rate of interest. In this case, it's 5%. And then on the bottom, it's the total equity. So this is quite simple. We don't need to look in both places. We just need to add together the total of the equity in the business and the total of the non-current liabilities to get the total capital employed, and multiply it by 100 because it's a percentage that we normally express this figure as, and that gives a gearing of 12.66%. And what we can see quite clearly here, it's below 50%, and therefore this company has got low gearing. Okay, I've given you a question to do, but then you need to come back to the video because I just want to go through quickly the advantages and disadvantages of gearing. Okay, highly geared. It's got some advantages. It's good because you've got more investment for growth. So not only got the shareholder investment, but you've managed to secure a large amount of loans from other sources. And if you make high profits and the rates of interest are low, you can magnify the returns that go to the shareholder. So it can be very, very good to make a lot of money very quickly. But there are a lot of negatives. You must pay the interest rates if profits are low or even if you make a loss. So that can magnify the downside. It limits the ability of the company to pay a dividend in bad years. If they don't make a lot of profit, they might be unable to pay any kind of dividend. And it increases your risk of bankruptcy. Because with shareholders, if you have a period maybe of 1 or 2 years when you can't pay a dividend, it's not the end of the world. The shareholders might want to sell the shares and the share price might come down, but you're not going to, the business isn't going to fold. Okay. And it can make it a lot more difficult to both raise money in the future because banks will look at this and other people who give loans to businesses and they will say this business is now quite risky, and they may also charge you a higher rate of interest. So there are lots of negatives. Being lowly geared, well, there's a lot of positives to that. You're not able to, there's a low risk the business isn't going to be able to repay loans and the interest charges. because it doesn't have a lot of interest and it doesn't have a lot of loans to repay. They should be able to raise finance if they need it in the future, and any finance that they do raise is likely to be at a lower rate of interest. But there are some negatives. The business will currently possibly have less money available for it for expansion unless it takes out the new loans. Quite often, lowly gear companies are at risk of takeover because that says that there's normally a lot of cash in the business, and that's something that other companies would like to get hold of. And it limits that magnification of profits for shareholders of their part of the return on the investment. So they're the negatives. Right, hopefully you've done the question, and